Hi everyone, welcome to another video in my Current Liabilities Lecture Series. This video is all about sales taxes payable. Sales taxes is going to be basically our first new liability that we've had to deal with since the kind of basic ones like accounts payable and notes payable and unearned revenue, the things we've been dealing with pretty much since we first went through the accounting cycle and talked about things like adjusting journal entries. So let's take a look. All right, so what exactly are sales taxes payable? Whenever you buy something at a retailer, if you think about the price you see on a menu versus, or a price tag versus the price you actually pay, let's think McDonald's. They have a dollar menu. When you order something off of that dollar menu, you don't pay $1 when you get to the register, right? You usually pay something around $1.07, $1.08, $1.09, depending on what state you're in. And the reason for that is because McDonald's builds in a sales tax onto the amount of money that they advertise. The deal with that sales tax is that is not something McDonald's is actually making money on. That is something that the government has mandated that retailers charge, and then they charge the customers that money, and then they collect it from the customers, and then they pass that money back to the government. And that's kind of how sales taxes work. So basically the description you see here up top, sales taxes are a percentage of sales revenue that is charged to the customer, collected by the seller, remitted to the government. So that's kind of the three pieces of dealing with sales taxes. The journal entries to do this will be, one, the actual sale that occurs. So when we learned about things like inventory, and when there's a sales transaction where somebody buys inventory, or from the seller's standpoint, you sell inventory to your customer, all we're going to do now is we're going to maybe add a piece onto that journal entry. We're no longer simply selling the inventory, we get the sales revenue, and we're done. Now we have to sell the inventory, get the sales revenue, also collect a percentage on top of that for taxes. So that's journal entry number one. Journal entry number two is we have to turn those taxes over to the government, what we call remittance. So let me write that on here. Remittance. And there's only really one trick to all this. So it sounds pretty straightforward, but when you see problems, and I'll show you an example of kind of with the trick, without the trick. The trick, as you see down here that I have in my notes, is that companies' sales registers may track this differently. Some sales registers will simply report how much cash was collected from customers. If you see how much cash was collected from customers, what you have to realize is that includes both the cash that belongs to the company and the cash that has to be turned over to the government. So essentially it's combining revenue and sales taxes into one number. So that's what you'll see sometimes in problems of this nature. The other way you might see it, which is a little bit easier, is the sales register will actually report sales revenue and taxes separately. And therefore you would combine the two to figure out how much total cash was collected. So it could go either way. I do have some example problems, so let's take a look at those, and I'll show it to you using both methods. All right, so first up is the separate. The separate is definitely the easier of the two. It says on November 21st, Flyer Corps sales register shows sales revenue of $84,000, on which a state sales tax of 3% was also collected. Record the journal entries for Flyer Corps' November 21 collections and the following day remittance to the state government. So we're assuming November 21 is when the sales to customers occurred. November 22 is when the taxes get turned over to the government. Now on November 21st, which I'll start my journal entry here, we know that Flyer Corps is earning sales revenue of $84,000. That was given in the problem. And so we're going to credit sales revenue, $84,000. But it also tells us that a state sales tax of 3% was also collected. And so we take our $84,000, we multiply that times 3%, and I take my $84,000 times 0.03. That gives me a tax of $25.20. And so when we say that we also collected that money from customers, what we're essentially saying is we collected $84,000 plus the $2,520 from our customers, which gives us $86,520 total. That's the cash. So we debit cash, $86,520. Now you may notice over here, the journal entry is out of balance. We collected more cash than what we recognized in sales revenue. So what do we do on the credit side to even this out regarding that $2,520? Well, remember, sales taxes are something that the government has the businesses collect and then turn over to them. Those don't represent revenue for the business. They also don't represent expenses for the business. They are simply, the money is being passed through the business, essentially. And so when you collect the cash from the customer, which you're doing here in this debit, you immediately have to create a liability to turn that money over to the government. And we call that liability sales taxes payable. And that's the credit of $2,520 on the day that we make the sale. All right, so that answers the journal entry of what to do on November 21st. The next question is what to do on November 22nd. And so I'm going to write November 22nd. This is the day we remit those taxes to the government. Remit just means we pay it. Well, if we're paying off a liability, the liability goes away. And so now we're going to debit sales taxes payable for that $2,520. And the reason we're getting rid of the liability is because we are giving that cash to the government. So credit cash, $2,520. Now, if you look at this holistically at this point, let me draw the T account for cash. And first up that happened was we debited for $86,520. Then we credited it for $2,520. And therefore, if we figure out what our ending cash balance was, it was $84,000. Notice that that $84,000 ending cash balance matches the $84,000 in sales revenue that we recorded in the first journal entry. And that's how this is supposed to play out. What, in this case, let's just say that, well, it wasn't McDonald's, it was FlyerCorp. So in this case, FlyerCorp earned $84,000. It collected that $84,000 from its customers. That is where we wind up when all of this is said and done. Along the way, they also collected an extra $2,500 roughly from their customers that they then turned immediately over to the government. They just were a pass-through that doesn't affect the income statement. It only affects balance sheet temporarily while they hold the money and have the payable on hand. But they pay it off so quickly that it doesn't end up really affecting things by the time the accounting period comes to an end. All right, now that was the separate version of reporting the information where you see here's the sales revenue and then you get, say, a tax rate. Some problems will be even simpler than that. Instead of giving you a tax rate, they will give you the sales revenue and literally the dollar amount for the taxes. And so if you add the two together, you have the cash and there's your whole journal entry. The harder version of the problem is when the numbers get commingled, when the sales register simply reports cash collected. And so here's an example of that type of problem. On February 27th, FlyerCorp sales register shows cash collections of $43,000. Now right then and there, before I even continue, we can start our journal entry because we know that's what it's going to ask us to do. 227, debit cash, $43,000. Notice the difference from what we did on the last problem. On the last problem, we started our journal entry and we began with sales revenue. This one, we start our journal entry and the first thing we put in is cash because that's the number the sales register is reporting. It tells us that the amount of cash includes a state sales tax of 7.5%. Record the journal entries for FlyerCorp's February 27 collections and the following day remittance. So we're basically going for the same goal. Now here's the deal. The journal entries that we did on the prior slide, we're basically going to mimic those journal entries again. We collected cash. Part of that cash belongs to sales revenue, so there's going to be a credit for sales revenue. Part of that cash belongs to the government, and so we're going to have sales taxes payable. The trick to this is figuring out how much belongs to each. The common mistake I see when I teach this in a live class is I ask students, can you figure this out? Can you figure out of that 43 how to break it out between the two figures? And the most common thing I see is students take the 43,000, they multiply by 0.075, and then they say whatever that number is the taxes payable. And that does seem to be the natural inclination. Oh, you have a tax rate, you have an amount, multiply them together. The only problem is if you did this math right here, what you're really calculating is what are the taxes on $43,000 in revenue? But you don't have $43,000 in revenue. We don't know what the revenue is. We know that we have $43,000 total, which includes both the revenue and the taxes. So this math right here, it doesn't work. All right, what do we do instead? Well, I like to show algebraically how this works out. So if you think about it, just in terms of, let's not use numbers, in terms of just algebraic letters, you've got a certain amount of sales revenue. I'm going to call that little s. And then you have to pay taxes on that sales revenue. And those taxes are the tax rate times the sales revenue. So we're going to go S plus, I'll call the tax rate R. So R times S. Okay? And that equals, if you think about it, your sales revenue plus your taxes equals your collections, or what I'm going to call C, cash collections. Now this is your basic algebraic formula, but it's kind of unworkable in its current form. And the main reason for that is because we've got two S's in the formula. And so we have to simplify. We have to somehow back one of those S's out. And so the easiest way to do that, again, if we just think of kind of typical algebra properties, is we can divide the left side by S. We can pull an S out from that current way of writing it. So let me rewrite it a little bit different. S plus RS. Let me write it like that instead of with the multiplication symbol. That way it makes more sense what I'm about to do. I'm going to pull that S out. I'm going to divide it out. And that's going to leave me with S times 1 plus R equals C. Now we're down to one of each variable. And from here we can simply say S equals, divide both sides by 1 plus R, C over 1 plus R. Now we've got something we can work with, because what we're saying is your sales equal your collections divided by 1 plus your tax rate. And in the problem, because of the way the sales register spits out numbers, we know the collections, 43,000. We also know the tax rate, 7.5%. And so all we have to do is say 43,000 over 1 plus 0.075. Let's move it over. So we've got 43,000 divided by 1.075 gives us 40,000, and that is our sales revenue. Okay? At that point, we can plug that into our journal entry. Sales revenue, 40,000. And the difference between the cash you collected, 43,000, and your sales revenue, 40,000, well, that is the portion that's due to taxes. So 3,000 are the sales tax payable. For the next day, February 28th, we simply pay that payable off. We're transferring the money to the government. So debit sales taxes payable, credit cash for the $3,000 in this problem. But the key to remember here between these two methods, if it helps to think of it in terms of math, in terms of algebra, is going back to the separate numbers. With the separate numbers, you're starting with sales revenue. And so you take your sales revenue times your tax rate, and that gives you your taxes. With the combined numbers, you're starting with cash collections. So you take your cash collected and divide by 1 plus the tax rate, and that will give you your revenue. So it's two different approaches, but it's because of the way the information is given. And honestly, even if you don't remember the formula, because sometimes math just slips our minds, think through it logically, like I did to set it up. Well, if we need to know how much cash was collected, we collected what we sold, and we collected the taxes, and the taxes are a percent of what we sold. So set up your equation the way I did. S plus R times S equals C. And that'll get you started and you can work it from there. All right, that's it for this video. Like I said, it's kind of our first new current liability that we've dealt with in quite a while in this course. It is a current liability. Notice we didn't talk much about the timing on this, but as you noticed in the sample problems, you turn that money around to the government really quick. The government doesn't want you holding on to its cash. The government wants its cash. And so you're definitely not making it more than a year without handing that money over, at least not without penalty. And therefore, sales taxes are pretty much always going to be a current liability. So we have one more video left in this topic where we will talk about another new current liability that we haven't dealt with before. I hope you found this video helpful. Hope you join me for the next one, and I hope you have a great day.